Unlock your home's potential, a comprehensive guide to HELOCs. Tired of feeling financially stuck? Your home's equity could be the key to unlocking your dreams. Let's explore how a HELOC can provide the financial flexibility you need, but also the risks you need to be aware of. Disclaimer: this content is for informational purposes only and does not constitute financial advice. Consult a financial advisor or lender to ensure a HELOC is right for your situation. Terms and conditions may vary. A HELOC, or home equity line of credit, is a loan that allows homeowners to borrow money against the equity they've built in their homes. Think of it as a credit card secured by your house. It functions like a revolving line of credit with a pre-approved borrowing limit. You can draw funds as needed up to that limit. You only pay interest on the amount of money you actually use. This makes it different from a traditional loan, where you pay interest on the entire loan amount from day one. The flexibility of a HELOC is a major draw for many homeowners. It provides access to funds when you need them, for a variety of purposes. The primary benefit of a HELOC is its flexibility. You have access to a line of credit that you can use for various financial needs. HELOC funds can be used for a wide range of purposes. This makes them a versatile financial tool. Home renovations are a common use for HELOC funds. Upgrading your home can increase its value and improve your living space. Debt consolidation is another popular application of HELOCs. You can use the funds to pay off higher interest debt, potentially saving money in the long run. Education expenses can also be funded with a HELOC. This can help cover tuition, books, and other related costs. Significant purchases, like a new car or a major appliance, can be financed with a HELOC. It's suitable for large, one-time expenses. The borrowing efficiency of a HELOC is a significant advantage. You only borrow what you need, when you need it, and pay interest accordingly. HELOCs are primarily distinguished by their interest rate structure. Understanding the different types is crucial for making an informed decision. Variable rate HELOCs are the most common type. Their interest rates can fluctuate over time. The interest rate on a variable rate HELOC is typically tied to a benchmark index, such as the prime rate. As the index changes, so does your interest rate. Interest rates can change based on market conditions. This means your monthly payments could increase or decrease. Payment variability is a key characteristic of variable rate HELOCs. Your monthly payments can fluctuate depending on the interest rate. Fixed-rate HELOCs offer a stable interest rate for a specific period. This provides more predictability in your payments. The interest rate remains constant for the fixed-rate period. This can be a good option if you prefer predictable payments. Monthly payments are consistent with a fixed-rate HELOC. This makes budgeting easier and reduces the risk of payment shock. It's crucial to understand the potential downsides and risks associated with HELOCs before applying. They are not without their dangers. A HELOC is secured by your home. This means your home is at risk if you can't make your payments. Failure to make payments can lead to foreclosure. This is a serious risk that should not be taken lightly. Rising interest rates can increase your costs with a variable rate HELOC. This can strain your budget and make it difficult to repay the debt. The draw period is the time during which you can borrow funds. After this period ends, you can no longer access the line of credit. The repayment period is the time during which you repay the borrowed funds. This period typically follows the draw period. Understanding the terms and conditions of your HELOC is essential. Pay close attention to the draw period, repayment period, and interest rate terms. Before applying for a HELOC, carefully evaluate your financial situation. This will help you determine if it's the right choice for you. Assess your ability to manage debt. Can you comfortably afford the monthly payments, even if interest rates rise? Consider your comfort level with interest rate fluctuations. If you're risk-averse, a fixed-rate HELOC might be a better option. Shop around for the best terms from different lenders. Compare interest rates, fees, and other loan terms. Understand all fees associated with a HELOC. These can include application fees, annual fees, and early closure fees. Align the HELOC with your long-term financial objectives. How will the funds help you achieve your goals? Make a well-informed choice based on thorough research. Don't rush into a decision without understanding the risks and benefits. A well-managed HELOC can be a valuable financial tool. It can provide access to funds for important expenses and help you achieve your financial goals. Approach a HELOC with a clear understanding of the benefits and risks. This will help you make a responsible decision. If you find the video is helpful, please like, share, and subscribe. Thank you for watching.